All right, welcome everyone. Welcome to the Hurley Investments Market View commentary for the last Monday in September, the 26th. I'm going to get all religious on you today. um, we're studying the Old Testament for scripture study this year. We went through Isaiah, and I couldn't help but find the quote, "Woe to them that call evil good and good evil, and one of them that are wise in their own eyes and prudent in their own sight." That just seems to be the theme that I see for this year. If you look to this year, it's everything I see. So I'm going to say this year's stock market theme, right? Now, I don't mean evil per se, right? But higher interest rates never are better, never are, let's put it this way, are never good news for the stock market and current bond holders. And someone asked me, they said, okay, Kevin, I don't understand bonds. And I thought I went through this before. So let me go through one more time because I think it's going to be good for all of us. And Stuart, I'm going to give you a call as soon as we're done here today. So here we go. What can we make on a current bond? Someone tell me. What can we make on a current bond? %. Love it. But what can we make maybe a year from now? What do you think? What do you think we're going to make a year from now on a bond? And I'm going to let you guys go ahead and say what you think. Okay, I see 8%, 7 to 8, 6 to 7. I'm going to go 7%, right? So here is the problem, right? One year from now, a 4% treasury bond will yield, I'm going to choose 8% because it's easier to do the math. 8%, right? Which means all the 4% bonds are worth half as much as the 8%, right? And that's pretty simple, right? Interest rate's going to keep going. All the 4% bonds this year are going to be worth half of the 8% bonds next year because the 8% will get twice as much interest, right? So what will the value be of the 4% bond purchased at $1,000? Thank you, Bill. Someone tell me, so what was that value? What you paid $1,000 for What is that value going to be? Huh, Stuart. Ooh. So Bill says 500. Trick question, right? The par value when the time runs out is always equal to 1,000, right? The trading value is only somewhere between 500 to $600. And the whole idea behind it is if it's a 10-year bond and you can make 4% more over those 10 years, how am I going to do this? 4% bond that you could make 40% more is discounted 40%. So all those poor people that have these bonds right now that are going to get churned out of bond funds are going to take could be a 40% hit. What if it's only a 1% bond? You know what? I had a car accident. We need to liquid our bond fund. Well, if they wait the 10 years, the 20 years, the 30 years, the 7 years, you get your $1,000 back. But if you liquidate all those 1%ers now, they're truly worth 25% of that $1,000, which is just pathetic. It's ridiculous for all those people that are in the bond funds. Another stock market theme for this year is going to be you don't fight the Fed, which means our market right now, I'm going to say is down 24%. I can get it more accurate. Our markets right now, S&P down 1.3% today, year to date 23.31% from CNBC, right? So we made the warning, market could be down 35%, right? Another 12% from right now. How? How do we hit 35% to the downside on the S&P 500? Someone tell me, how are we going to hit 35% to the downside on the S&P 500? Love it. Inflation worries. But how do we fight inflation? Because it's going to be more than inflation worries when you're already down 23%. Great answer, but I'm actually looking for more than that. Less QE, well, we are doing less. I mean, we are doing less QE, but there's something other than that. What caused the last 2 weeks to go down? And I really hope you guys have been paying attention to your accounts. Interest, right. Interest rate hikes. How much more this year? Any idea? How much more this year? October, right? We're expecting 0.75. Can we get a December 0.75 as well? Two of you typed in 1 to 1.5. Would another 1.5% interest rate hike kill the markets? Yeah, probably, right? What else? What else did our lovely Fed say? All the Fed does is make bubbles and burst bubbles. Love it. Will severely cripple the market. Love it. There we go. Wants 4.5% unemployment rate. I thought their job was to keep people employed. Why in the hell is he looking for a higher unemployment rate? I don't know if you guys paid attention. Last 2 weeks before today, the S&P 500 was down. I had it at 9.3, but I did see it at 9.8. Again, CNBC. Hurley Investments, 0.0056. Kevin, what are you talking about? It's days like today, right? Notice how our cash has increased by $400,000. Cashed in some Baidu puts on Friday. Cashed in some Apple long puts today. Roughly 16 million. We were up $1,200. Nothing to brag about, right? But if you take, we'll do it more accurate. If we take 15, 9, 20, 573, we multiply it by the 0.013 or 1.3%, we should have been down 206,000. Hold on, $967. If you want to get technical, and 44 cents. That's how much my group should have been down here. $206,967.44. Some of you check your accounts today, you're going to be up. You're going to be up on the day. Not a bad day in the stock market when you can the stock market by over $206,000. And that's what we've been doing the last couple of weeks. Briefing picture, I really enjoyed this. The bond of friendship between the Fed and the stock market is broken. It's a gift to have a best friend in life. There's someone you can lean on in times of need or just hang out with. to make the fun times even more fun. A best friend can support you with positive feedback and sometimes support you through tough love by giving you feedback you don't want to hear but need to hear. What a best friend won't do is abandon you. They will stick with you through thick and thin. All friendships, though, have challenges, even the best of friendships. The stock market finds itself dealing with a challenge right now. Its best friend, the Fed, is breaking the bond it formed with the stock market for the better part of the last 14 years, and it isn't apologizing for doing so. It is hilarious to read the first 4 sentences of what's happening right now. Maud, I'm going to hit that in just a minute. When you get to what it all means, what we've been used to through our bull run is no more. In fact, if anything, slower account growth will go for better stock picking. Climate change in the stock market means we're going to hit more interest rate hikes, which also means it'll make Hurley Investments and protecting your portfolios that much more important. It's ridiculous. It is absolutely ridiculous. As I went through briefing, September's down 6.6%. Where was it? I don't have it. I stuck it somewhere else. But when you guys ask me, where are we looking to go on the S&P 500? You have to go back quite a ways. In fact, maybe let's find it. Let's go back quite a ways. Let's go back and see if we can't show our next level of support. We're going to pull it back 5 years. My thought sits right here. 32.33, 32.33, and technically you can find one sitting right here. They all line up right here. So there's a triple, if not quadruple, if not 5 times, you can find levels of support or resistance right there at 32.33. 32.35, 32.25, that's where we're looking to most likely see our stock market go here shortly after, probably next week. I told you guys it could be this week, but my expectation would be that we would come down and meander around 36.36 to 3600, and we're already oversold. We're already to the point where we're down pretty far, and you don't see, at least not that I've seen, you don't see stock markets in oversold conditions for a significant period of time. Already the futures are up 0.55 on the S&P. So my thought, if we can get through this week, we're going to have a bounce, and it'll be a rebound. And the rebound might hit 3,900. It might hit 4,000. It might hit the 50-day. But then we're going to get hit again with the rate hike. And at that point, I think the market is exasperated. Because what catalysts move our market higher? There are a couple out there. Maud, you somewhat already stated one, but there are a couple catalysts that will move our market higher. So let me just throw those up here. possible market catalysts to move it higher into the end of the year. First one, easy. Christmas rally, right? Which all in essence is catch up for money managers. It's seasonal, right? Number two, elections. And the elections, Republicans must win the House, because it will stop funding for executive orders and put government into gridlock. You can't get true gridlock by just winning the Senate. And third but not least, Fed commenting on a pause in interest rate hikes to let the hikes take economic effect. What does this mean? We have a 10% down year. What does it mean for you guys? If we add shares here shortly, you have a 13.3% upside plus another 10 to 20% with shares added, which is how you beat the market in 2008 and 2010, 2018, 2020 with our stealth pullback. It's how we do it. It is the beauty of the collar trade methodology. It's truly that simple. And that's what we do. Now, what we're looking at, we're looking at bounce higher. We took off our extra Apple long puts, and Apple will be the first one that will take off put positions. Baidu will be the second one that we will take off put positions. I'm just going to verbally go through some things here. Bank of America. Bank should be doing better. Bank of America, we might not take them off till $32. Boeing, really close to taking off put positions. Disney will not take off put positions till above 100. Ford, very close to taking off put positions. Google L, we will not take off put positions until it breaks 100. JP Morgan will not take off put positions till it breaks 109. Meta, we're very close to taking off put positions as well as the extras. Micron has earnings on Thursday. What else do we have here? Under Armour, very close to taking off positions and adding shares now because it's at a historical bottom at that 750 range. Visa, very close to taking off positions. We're very close to having that trough to manage having stocks added to it, which means when we get back up from this little 10% push higher, It's not even 10%. It'll probably only be 7.5%, 8% higher. Protection's going to be going back on for earnings that start towards the end of October. All right, let's see here. Big week. We have GDP on Thursday, personal spending, personal income on Friday, new home sales, durable goods tomorrow, which means, in all honesty, our futures right now don't matter. We have currently have put protection on everything with extra 10 to 50% more puts for shares, which is how we've been coming to that point where we're making up more on the way down. We also have SPY long puts and put spreads in play. So that's how we're doing what we're doing. It's not weird voodoo magic. I'm just have extra going in where we've literally missed a 10.5% downward movement. Found an interesting article on these cash-free favorites. Probably picked it up because Meta, Bank of America, Marathon Petroleum was an interesting one for some of you that said what might be one that we might get into. Marathon Oil and Murphy Oil would be the oils I'd be interested in. Very interesting article. Bond market plunge means low for stocks is not yet in. To understand the inverse relationship between bonds and stocks, please read this article. It'll be posted on my Hurley Investment. Boy, I've got it in here twice. I guess I thought it was so important. I thought, why not double up on it so you guys really will take me seriously. Is it time to buy treasuries? Here's how to allocate your portfolio according to the pros. I put this one in here because I strongly, strongly disagree with it. Now is not the time to do a bond fund, but bond rates are pushing to the 4.24 and 2-year treasury yields are amazing. So I would not suggest or allocate now to do it, but if you had extra cash and you're looking just for a tax-free cash flow, you can now get for 2 years that 4.14%, which means you have to plan holding it for the 2, 5, or 7 year time frame with the with the yield curve inversion for long versus shorts. Once again, SPACs are garbage. Trump SPAC is now $16 when it was $97 a year earlier when you bought in at $100 per share. SPACs are worse than REITs. Don't buy SPACs. Understand our market bottom retest is on the way right now. Right now, we are retesting the bottom of our stock market. We're testing the lows at 36.36. I found it interesting on Bloomberg and on CNBC. They all said we tested the lows. They all said, yep, we tested the lows. As far as I see, the low was not 36.45, it was 36.36. I found it very interesting that both of them said that we were testing the lows, weren't quite there, but I guess for them they were close enough, whereas Fox said we had not tested the lows yet. All right. Interesting article, why are rents increasing? This is just here for the Salt Lake City area. I found it a very interesting article that you might want to pay attention to on housing markets in certain areas. Tech stock had their worst week stretch since the start of the pandemic. This is the NASDAQ. The NASDAQ did a plunge of 10.6%, 1% worse than the S&P. And I found it very interesting, and I got this sent to me from Armstrong on Sunday. Who started the war, Ukraine or Russia? Who started the war, Ukraine or Russia? I'll be honest with you, I thought Russia for this whole time period, right? Russia started it. Do you know Russia entered one day after Zelensky made the comment that that he was expecting to be armed with nuclear weapons? And I kind of was like, that's bull crap. That's just, and I'm not a Martin Armstrong guy at all. I disagree with 99% of what he says. But if you go back, very interesting to find out, because you can find it all online. Zelensky basically said, hey, Ukraine is going to violate a couple agreements that have been in place since 1991. And he wanted to pursue, he flat out said, we're going to pursue nuclear weapons to counter Russia. The next day, Russia invaded. So, I'm shocked. I'm shocked as I got this article and started to validate it for what I could find online, that I found everything that the article said. There's plenty of evidence out there that supports the fact that Ukraine and Zelensky, for all intents and purposes, pushed Russia into this war. I never knew. If you would have asked me until Sunday morning, Russia started it. Russia was part of it. They just were land grabbing. The short answer is they were pushed into it. Everything out there says they were 100% pushed into it. Maybe Zelensky expected more help and he's just not getting it. A very interesting read. I'm going to put it out there for you guys to read. But what questions do you guys have? Any questions you guys have trade related that I can maybe answer for you? Abraham, I agree with you, but wow. Again, I never would have thought these things lined up. Again, I hate Armstrong. He's been in jail. He's been in jail for good reason. He ain't that good. But as I went through his article, I feel a little, I guess I feel like I should have known earlier and I didn't. All right. Any questions in regards to portfolios, in regards to the market? Anything I can answer for you? Maud, that link will work every single time. If you're not getting the reminders, I've been a little busy today. I haven't checked to see if I was getting the reminders. So we'll make sure. Yes, I'd prefer the reminders as well. All right, guys. Hey, I see no questions coming in. I appreciate you guys showing up tonight. I look forward to going over portfolios with you in Kyiv on Thursday. Let's see if we get our bounce, our little bounce where we can cash in our profits, try to make up some money on the downside to add into stocks, but being ready with the 7 to 8% bump higher to get our protection right back on again. It's time to be nimble in our stock market. Very nimble. Very, very nimble. All right, guys. Hey, I don't see other questions coming in. Great to see you. I'll see you next Monday if you're not here on Thursday. And other than that, good night, everyone. Bye-bye.